The S&P 500 is starting Monday's electronic trading session with a sizable gap to the downside. Already in the Asian session, the expected move at 7,586 points was broken, and we are sitting deep in negative gamma territory. So, further volatility is, as things stand, likely. None of this comes as a surprise because the shooting started again over the weekend. The war between the United States and Iran has escalated seriously once more, and how this conflict develops from here will very probably have a major impact on prices over the coming week. My name is Oliver Sparring, I'm head of trading at TradeNeon, and just like every Monday, I welcome you to our level of interest market briefing. In this format, we take a look together at what the trading week has in store for us. We go through the news, the important economic data and earnings, and of course, we look at today's market analysis with our level of interest software to show you where institutional interest sits in the market. Together, we work out a trading plan for the day and the week ahead. Let's get started after the intro. Before we turn to the chart, let's first look at which news stories will shape the coming weeks. This week it's all about inflation once again. On Tuesday we get the US consumer prices for June, on Wednesday the producer prices, and on Thursday retail sales. So exactly the three data points that are driving the Fed's rate path most right now. For the headline CPI, a slight decline of 0.1% month over month is even expected after 0.5% previously, a noticeable drop that mainly comes from the energy side. The catch lies underneath. The core rate is expected to tick back up a little at 0.3%, and the year-over-year rate stood at a stubborn 4.2% recently. So the Fed is far from in the clear. On top of that, Fed Chair Kevin Warsh delivers his semi-annual testimony before Congress on Tuesday, and because the market has recently even been speculating about a possible rate hike in September, every 0.1% on the core rate carries extra weight. But the real explosive material is in the timing. These June numbers look backward, while the weekend escalation in the oil market is now threatening fresh price pressure from the front. So this could be the last cool inflation print before oil feeds back in. As always, we look at the relevant LOI zones before the data comes out. More on that in a moment. In parallel, the Q2 earnings season kicks off. And as always, the big US banks go first. 5 heavyweights report on Tuesday before the US Open: JP Morgan, Bank of America, Goldman Sachs, Wells Fargo, and Citigroup. In the same window as the CPI, which makes Tuesday morning the real key moment of the week. With the banks, it's less about the raw number than the tone. Above all, Jamie Dimon's read on the consumer, credit quality, and geopolitics regularly sets the direction for the whole sector, and Goldman is being tipped as an outperformer after the strong trading environment. Things get really relevant for the broader market afterward, the chip sector. ASML reports on Wednesday, TSMC on Thursday. The two of them are the most honest gauge of whether the AI capex boom that has carried the index for months is really continuing. Netflix closes things out on Thursday after the bell as the first big tech and consumer name of the season. The stock is clearly down on the year, so the market is watching the advertising business especially closely. Bottom line, two questions decide this week. How healthy is the US consumer according to the banks, and is the AI boom still holding up according to the chip names? The weekend has completely flipped the starting position. Renewed US strikes on Iran and the Strait of Hormuz closed to shipping according to Iranian sources, through which around a fifth of the world oil flows. The strongest conceivable risk-off trigger right at the start of the week. In parallel, Ukraine is expanding its drone war against Russian oil tankers, so there are now two supply shocks running simultaneously, which means Friday's friendly closing prices with the S&P at 7,575 and a calm VIX around 15 are effectively obsolete. For us, that means a Brent gap and a possible VIX spike into the US Open are right at the top of the watch list, because an oil shock feeds directly into exactly the inflation worry that's already on the agenda this week. On top of that come two quieter but relevant themes. The SpaceX share price is trading below its issue price a month after the IPO and is dampening risk appetite for new issues. And the warning from 14 nations to China over the South China Sea keeps the latent supply chain risk in the back of our minds. So, the overall picture is clear. Whether we get risk on or risk off this week will mainly come down to whether the oil price keeps a lid on things, or whether cool inflation data and a solid start to bank earnings settle the nerves again. That covers the fundamental starting position. So let's look at the price itself. As you know, we still run our market analysis before the European exchanges open, and we don't change it over the course of the day. So we're currently still in the overnight session. As mentioned in the intro, the market opened with a hefty gap of 0.25% to the downside. Since then, there's been a slow but steady sell-off. That doesn't have to mean much at this point, though. As you know, we've often seen exactly this play out very impressively in the opposite direction over the past few days. In their session, the Europeans laboriously worked the prices higher and established an uptrend. In the first half hour of the US cash session, however, that got torpedoed and the opening gap was almost always closed right back up. Right now, the market has found a temporary floor at the negative gamma level at 7,568 points, which is additionally supported by a Fibonacci level from the higher order trend. Between 7,620 and 7,540 points, we're in a Vanna Bear Zone. So the market makers from the options markets are giving us pressure from above here, while gamma drives elevated volatility. In this price range, high market speed is the order of the day. As long as the price is below the previous day's VWAP close at 7,600 points, I'd primarily look for short trades at our levels. It's fair to assume that the market will keep finding support at the hedging level and at the latest down here at the span interval at 7,560 points. These levels are best suited for taking profits though, but not necessarily for opening new long positions. I'd only be truly bullishly positioned once the market can break the settlement level at 7,620 points to the upside and stabilizes within the bull zone above it. Above the previous day's high, at the latest, we can then look for long entries with a clear conscience. A breakout through this level and a subsequent pullback would be a nice opportunity because we have plenty of room to the upside up to the next larger resistance at 7,652, where the upper expected move and the upper edge of the Vanna Bull Zone would sit. Please remember, these are not trading recommendations. Everything I'm telling you is for purely educational purposes. Things get really critical if the market manages to break the lower edge of the bear zone at 7,543 points. In that case, institutional market participants would have to reckon with margin calls and completely adjust their positions and risk management. Very fast and violent sell-offs are possible here, and I would not recommend still trading in this price range. Please also always keep in mind that these levels are a market analysis that can tell us where we can find good trade entries and in which direction trading is worthwhile. But the levels always have to be combined with a validated and backtested strategy, ideally from the order flow, to build a working trading system out of them. As you know, simply placing limit orders at the levels and hoping for the best doesn't work. I wish you all a successful start to the week and good trades. Starting next week, we'll be taking a summer break for a few weeks. Institutional trading is heading off on holiday, and we'll use the time to work on new projects for you. I'll tell you more about that shortly. If you have any questions about our market analysis or level of interest in general, feel free to write to us in the comments. We're of course also interested in which topics you'd like us to cover in the coming videos. After all, we want these formats to deliver as much as value as possible for you. You can find more information about level of interest on our homepage TradeNeon.com. We look forward to hearing from you. Feel free to drop us a like and subscribe to the channel if you don't want to miss any more news and analysis. Until next time, take care, have a good summer.